Welcome back to the next video in the series, and it's been a little bit of a break, but August is traditionally a fairly quiet month in terms of the amount of participants in the market, and often moves that occur in the market are often more not representative of what I feel is a true market, because many traders are off on holidays and the market tends to get more realistic towards the middle of September. So anyway, welcome back. Now what I want to do is, there's been a lot of activity this past week and a half, as you've probably gauged from the markets, and there's something I want to talk about, and I refer to it as financial communism, because basically that's what we're seeing from the central banks and the powers that be as far as the rulers of the market are concerned, or what market should I say. In particular, I'm going to touch on a few areas. I'm going to touch on negative interest rate policy and why I believe that is akin to a command and control economy that was in some way like the old Soviet style economy. And I'm going to touch on the logical effects of what happens with negative interest rate policy on investments and the likes. And so let's get into this basically. Now what I want you to do is I want you to look at this particular paper, and it's from two chaps called Richard Argowal, I hope I pronounced that right, and Miles Kimball, courtesy of the IMF, and they did a working paper on the negative interest rate policy for the IMF. Now seriously, you couldn't make this up. Let me just read out a bit from this particular paper in the summary, and you can see what I mean. Now, in the summary, the experience of the Great Recession and its aftermath revealed that a lower bound on interest rates can be a serious obstacle for fighting recessions. However, the zero bound is not a law of nature. It is a policy choice, and that's extremely important. It is a policy choice, which I'll show you is completely erroneous later on. The central message of this paper is that with readily available tools, a central bank can enable deep negative rates whenever needed, thus maintaining the power of monetary policy in the future to end recessions within a short time. No, that doesn't, reality doesn't happen that way. There's no way. Now, let's have a look at a few facts in this, because I mean, when you start looking at the academics as far as negative interest rate policy are concerned, and they're coming from the IMF, then you can bet your bottom dollar that the IMF and Bank of International Settlements are creating policy on the go effectively for the world central banks, especially those of the European Central Bank and the Fed. So, having mentioned monetary policy, these negative interest rates, where there's no bottom as far as they're concerned, is basically monetary policy on steroids. So this is of major concern going forward, and as this video goes on, you'll see why. Now, as you can see from this particular slide, you can see that there's been a massive jump from 2016, from the period 2016-17 to the current period of time, where we've seen a massive increase in the amount of negative interest rate bonds that are available in the market. And these negative interest rate bonds typically include not just government bonds, but also corporate bonds as well. And this is quite important, as you'll see in the end of the video. Now, if we actually have a look at this particular chart, we can actually see that there was a dip between middle of 2006, well, there was a peak of close to 11 trillion, halfway through 2016, which reduced in intensity to the middle of 2018. So we had somewhere around 7.5 trillion in negative interest rate bonds that were available to the market in total. Now, so you can see from the middle of 2018 to the current level of today, we're talking 17 trillion. Now, that's a massive increase in negative interest rate bonds. Now, why has all this basically happened? I mean, if you look at this article by John Ainger, and it was basically written on August the 30th, so it's fairly recent. He basically said in the bottom, he says that the negative yield phenomenon is turning financial markets on their head raising the spectre of a bond bubble, draining pension funds of a valuable resource of income and incentivizing riskier companies to mortgage their assets. At the same time, banks are having to reassure citizens that they won't suddenly start charging customers to store their money. So we can see that this is effectively something that's absolutely new. A lot of investors are having to go into these negative yielding bonds. The banks are at a quandary whether or not they should actually start charging their customers to save their money with them. And this puts the banks in a very awkward position, excuse me, which I'll go into a bit later. Now, something that's a very worrying note that's actually occurred is when bonds are priced, they're priced on yield, but they're also priced, and the risk is also on duration. Now, what we've seen when we looked at that last image of the yields, of the amount of bonds that were negative interest rate, we've seen that massive, we've seen just over 11 trillion from around 2016 dip to about 7.5 trillion. And well, that was because the duration of those bonds was somewhere in the region of 2 years. So the bonds effectively, matured. But what's concerning at the moment is that the duration of these bonds, which therefore equates to risk, has actually increased. And we've seen an increase, a stark increase, for example, in the German bunds. Their 30-year bonds was recently, just until the last week, into negative territory. It's slightly crept above positive at the moment. I think it's about 0.08% for a 30-year rate. Now, last week, it was 0.03%, so negative 0.03% for 30 years. Now, let me put that into context for you. And that's not forgetting the Austrian bond auction of last month, in August. Basically, they were able to sell 3.5 billion of 100-year bonds at negative rates. Imagine that, investing in a bond for 100 years. Let me put that into perspective. Back in the early 1980s, when there was massive inflation and Volcker was the head of the Fed, interest rates were around 15%. Now, that's 38 years ago. Now, think of it like this. If you had bought 30-year bonds 38 years ago, look at the changes in 30 years. 30 years is just incredibly long to be holding a bond portfolio, let alone 100 years. Now, what's very important in this, as was pointed out in this article by Wolf Richter from Wall Street on August the 6th, 2019. I'll read this out to you, and this is really important. There are no German government bonds that trade with a positive yield. The German 30-year yield for bonds due in 2048, the longest term available, dipped into the negative briefly on Friday for the first time and sank solidly into the negative on Monday and Tuesday, currently at negative 0.036. The Swiss 30-year yield has been negative since mid-2016 and is now at negative 0.322%. But the Japanese year is still positive 0.29%. Now, I'll go into the Swiss later on, where it all started. It's quite important to look at this later on, so just remember that about the Swiss. Now, going forward, investors who buy these bonds hope that central banks will take them off their hands at even lower yields and higher prices. No one is buying negative yielding long-term bonds to hold it to maturity. This goes back to what I've said about the 30-year and the 100-year, but it'll become extremely important, as you'll see at the end of this video. Now, and reading on this, and this is the irony of the moral hazard that we have in markets today, in generally every asset class and every asset manager. I say that but these are professional money managers who buy such instruments or have to buy them due to their asset allocation and fiduciary requirements, and they don't really care. It's other people's money, and they're going to change jobs or get promoted to start a restaurant or something, and they're out of there in a couple of years. Après moi le déluge. And that basically means after me, the flood. So, there are market commentators who can see that this is an irrational market. In irrational markets, the universe works on rationality. It doesn't work on emotion. So when we go back and we look at this, when we look at this particular yield, the amount of negative yields in trillions, and see that the 17 trillion, no wonder this is quite a worry going forward. Now, what I want to show you as well is that the current graphic is showing you the amount of share of government debt with negative yields as of the end of June 2019. Now we can see from this graphic that Sweden, Switzerland, Germany, Finland, the Netherlands, Denmark, Austria all have well above 70%, even France, 70% of their sovereign bonds are negative yields. I mean, you couldn't make this up. So basically, think about their sovereign bonds, barring Switzerland, which I'll go in a little bit later too. Switzerland started all this off, by the way. Excuse me. Now, if we look at all these negative bonds, these bonds, once they go out of the money, are going to be completely toxic assets on the balance sheets of the tier 1 capital of banks in Europe, as if they haven't got enough problem with non-performing loans and margins that are being crippled with this negative interest rate regime. Major trouble ahead for European banks when this bond market implodes, and it may have already started, as you'll see later. So you can see that BRICS countries like Portugal, Italy, Spain, Ireland's toppish, but you know, at the end of the day, you can see that these amounts of government debts are very high. But one has to consider this, is that it's the amount of the government debt as well. Now we know that Italy, for example, has nearly 2 trillion euros of sovereign bonds, but it has 12% of those in negative yields. So we can see that the market has, to some extent, not got a lot of appetite for Italian sovereign bonds. But we have other countries like Spain, which is, I think it was 1.6 trillion euros of foreign debt, and yet it's got, what, 60%? It's nearly 60% of its debt's negative interest yields. Has the risk gone away? No, it hasn't gone away. These are still pigs countries, and they're just waiting for a crisis to come, basically. They're more unstable than the likes of Germany, which is going into recession. So if Germany goes into recession, what's it going to be like for these particular countries? Not very good, I'm afraid. Now let's go on to because this is an experiment. In this next slide, we can see that from Jim Bianco, founder of Bianco Research, in a very recent CNBC Money article, we can see in the following chart total negative yielding corporate bonds outstanding. You can see how that growth has been exponential between January and July of this year, and this correlates towards the exponential growth between the middle of last year and the current period at the moment. I mean, estimates are that we could be facing 19 trillion by the middle of December at the current rate of growth. Now, the reason why I'm showing the corporate bond growth is because what goes on in the corporate bond market is very closely allied to what goes on in the sovereign bond market, because bonds are bonds at the end of the day. And I just wanted to represent this, and basically what Mr. Bianco has said is the trend poses a potentially dangerous threat, especially if market winds shift and bondholders looking for price gains rather than yield get stuck holding too much risk. And I say at the end of the video, show that this risk has probably come out to roost now. Now, he also said that interest rate risk that these bonds carry is huge, right? Bianco said in a recent interview, the financial system doesn't work with negative rates. If the economy recovers, the losses that investors would take are unlike anything they've ever seen. So there's real danger ahead in this. Now, what I think, I mean, I could go on and on and on about this, and I don't want to, because it's a scenario that is likely to happen. It's not a question of if, it's a question of when. And I think the things are starting to unravel at the moment, and I think you need to watch this space. Now, there are several issues going on here. Now, governments are piling on negative yield bonds to kickstart inflation. It's not working, because it's tantamount to sticking your finger in a hole to stop a dam bursting. It just doesn't happen. And it's really important to consider that it's government policy, it's the government policy in power, or government's policy in power, has become the market. It's not hard to draw the similarities to what I call financial communism, because it's a diktat of the central command of the central banks, of governments manipulating the markets to suit their spending patterns that is distorting risk and value throughout the whole system, and it can't end well. Now, how do they do this? Well, yields are suppressed with printing money via bonds, effectively. Basically what happened with quantitative easing. And if you issue enough bonds, then you can suppress the yields as much as you want to. So what does this mean ultimately? Well, what it is that the governments in particular in Europe via the ECB have made it mandatory through Basel III and central bank policies. And this goes back to what I said about Messrs. Argowal and Kimball, about how they were formulating the policy going forward in negative interest rates. Because they force the banks and institutions to hold these instruments, and therefore they get the money to spend on their socialist policies. So effectively they've done a very socialistic grab and control of financial markets. And they're doing this through central bank policy. And it's what a joke is, because when you put a negative interest rate bond, or whether it's sovereign or whether it's corporate, into a bank's balance sheet, they would traditionally have to mark that effectively as, well, in normal accounting terms, not bank accounting terms because it's a bit different, but in normal accounting terms, an asset is something that produces money. And bonds typically, because they've produced interest rates, have been assets. But in the balance sheet, where the bank has to pay money for bonds, or savers have to pay money for money in the bank, these become liabilities, and they become toxic liabilities when they go bad. So what they're doing is they're printing and they're forcing consumption of those bonds, and it's a pig fest. It really is a pig fest for zombie companies. Because look, if you can borrow to close to zero or to negative rates and pay the debt pay this to shareholders as far for dividends, you don't need to be competitive. You don't need to be efficient. You don't need to improve margins through investing in R&D. And then guess what? Well, the rates rotate. Like there's a large market rotation in the value stocks in August. Your company goes from the living dead to really dead. It's completely disastrous for risk and efficient asset allocation. There's no other way to put it. So money has always got a cost. It's always had a cost. Otherwise, it has no value. Same with lending bonds. The idea of bonds goes back thousands of years to Babylonian times, when grains and things and commodities were promised in the future, and in medieval times. So it's been with us much more so than the notion of currency. So the hidden effects are disastrous. What we're seeing is arbitrage on a scale not seen, which happened in August when investors and institutions sold euros and yuan to buy dollars to buy bonds. This caused the yield curve to significantly invert. So everybody's saying, massive recession, sell off stocks. Well, for the moment, I believe this inversion is for once a false inflationary flag. And yes, I know I've been saying in previous videos that when you have a yield curve inversion, it is signs of a recession, but typically it's 22 months to 24 months in the distance. It's not imminent. So my belief is this is a consequence of negative interest rate policy. And this is causing another effect. This is causing a currency war to break out. By reducing rates to negative territory, it's got two beneficial effects for governments. It reduces their debt burden to pay back the debt, and theoretically causes a devaluation to make their exports more competitive. Now, this is where I go back to the Swiss scenario that I mentioned before the video. In 2016, they devalued their currency because people were looking at the Swiss franc as a safe haven currency and distorting the value as they perceived it. So they said, okay, we're not having this. We're putting in a regime of negative interest rates to discourage people from buying the Swiss. In other words, they'd have to pay a discount to hold their deposits in Swiss francs, and it had some effect, and it did have the effect of lowering their cost of imports, and it's had very minimal effects of importing inflation. So other countries say, oh, if it works for Switzerland, it's going to work for us. It doesn't work that way, because look at Germany. Is Germany going into recession or what? Of course it is. They're only fudging the figures. So negative interest rates haven't spurted the Swiss economy. They're not going to do it to Germany. Now, the Germans think that this is going to work and stimulate their economy. It's not going to work. It's not going to work because there's too much debt. there's just too much debt in the ECB. The Germans aren't used to having a lot of debt. What they prefer is other people get it, but not themselves. And if it's still going into recession with negative interest rates and they fudge the figures, then it's certainly not working in that sense. Now, what could go wrong, and this is where it really does start to get hairy. Massive amounts of debt, and we've seen a massive accumulation of that debt, as I say, from that slide, from looking from 7.5 trillion over a year ago to 17 trillion at the moment, potentially 19 trillion if this continues by December. This debt needs to be repaid, and we've also seen that from the comments as well that from Mr. Richter, the bondholders don't want to hold these bonds long term, but the point is that the risk, as Mr. Bianco says, is that the losses from these bonds could be like anything that's never been seen before. So the problem is nobody wants to buy a loser. Now, what actually occurred and has made me think that this is actually quite a worrisome thing is that there's been a pivot into US dollars, a massive pivot into US dollars value stocks and bonds at the start of August. So basically what it means has been massive currency swaps going on, and the market is very short US dollars. There's always been, say for example, US dollar shortages even in China because of the pegging of the yuan and the shenanigans that the Chinese do. They're quite short US dollars, so you can forget about them liquidating their reserves in any time at the moment. If anything, they're going to be out in the market buying US dollars sooner rather than later. But what we have to look at is what happened last night on the repo market, and this is a scary slide. You can see that last night the repo market peaked at 10%. I mean, you couldn't make this up. That's the riskless overnight borrowing, and so if the riskless overnight borrowing peaked at 10% and they don't even know why it peaked at 10%, it basically means that there was a short squeeze of US dollars, that there was a mad rush to get US dollars yesterday. And as I said, a lot of this is covering the US dollar swaps, which were funding the transfer into value stocks, equities, and US bonds on an arbitrage basis. So what we're seeing is that there's been a massive pivot from negative interest rate countries and economies into US dollars in particular, simply because, well, why would you lend your money for 10, 20, 30 years and have a negative yield on it when you can go into US dollars and get 2% or thereabouts? And if you're an institution, you owe that due diligence to your investors. So, and this is why the Trump administration has been begging the Fed to cut interest rates, not necessarily because it sees recession coming down the track. If it is, if we look at what's happening in Europe, but it's because of this massive revaluation of the dollar affecting exports and the arbitrage facilities that are soaking up the US dollars. That's not a good position for the Trump administration to be in when it's in the middle of trade talks with China, which to this moment I don't think are going to be successful. IP is too big a problem, but that's more videos down the line. So this spike, going back to this spike, 10%, and it's not been reported in mainstream media very much at all, if at all. The New York Fed had to put in 52 billion in overnight funding just to liquefy the market. Now this usually happens in the last quarter, the last few days of the financial year, because companies have to have a square balance sheet effectively as far as US dollars are concerned. So this happening now in the middle of September is really a major worry, and it would really make me worry if I was a holder of negative interest rate bonds, and I'll tell you why. Think of it like this. If you're a holder of a negative interest rate bonds and you have to refinance those bonds up to 10% in overnight money because you've had to swap out those bonds in a currency swap or an interest rate swap, then you're in deep dooey. You basically are going to start looking to the exit soon if this repeats itself, because this dollar shortage is not going to get any better. And as soon as investors start realizing that there is a shortage in this side of things, then those bids are going to go up on overnight money, and 10% is not going to be a rarity. there are going to be higher bids than what's necessary to refinance these swaps. So the danger is it's going to be a massive rush for the exit all at once, and that's when the bond market, especially the corporate bond market, collapses. So we have potentially a bond crisis happening now, not necessarily later. And so what does this mean? Well, this brings me back to the financial communism side of things. You see, under the old Soviet-style communism, what we had, it was a supply of goods that the command and supply interference destroyed, because what it did is decoupled natural demand and supply measures from the natural filling of productive gaps in the market. And therefore, the production was distorted to the extent that resulted in empty shelves, because there was no indication of what was necessary, what was efficient, or what should be there, because demand and supply were non-existent elements. It was purely based on policy, which goes back to what Argyle and the other guy basically said in the opening statement regarding the IMF, Kimball rather. So we have a command and control economy as far as financial assets are concerned that's been run by the central banks. You can almost think of it as a bunch of apparatchiks who have engineered money, the supply of money, just like taking away the influence of market pricing. So therefore risk and value are non-existent in today's market for the moment. So what was this? I mean, basically what we're seeing engineered, I mean, in communism we had the empty shelves, food shelves. What we're going to see with this is empty money shelves. In other words, what we could see coming is the mother of all liquidity crisis. So how's this going to affect you as an investor? Well, put it this way. I've made videos before in the Russell 2000, and because what's quite shocking in that one is that 65% of those shares, those stocks, are heavily in debt. Heavily in debt. Well, that debt has to be financed, and if you start getting a repo rate that starts climbing up, then those swaps and those bonds that they've got entered into are going to start looking very, very sick. And so what we're going to start seeing is mid-cap, small and mid-cap funds starting to go under debt pressures. And this is why I've said before, debt is the enemy of this market. The crisis that's coming is a debt crisis. It's not an equity crisis. The debt crisis will spurn the equity crisis, and that's not even taking into account the complete and utter devastation that will occur once these derivatives are well out of the money, because the choppiness of the markets and the volatility is undoubtedly hurting a lot of banks and their derivative books at the moment, especially the interest rate swaps. So there's a lot of juice in this market that could go sour very quickly. And so when the debt starts to not be repayable for these companies, they're going to go broke. When they go broke, the index funds have got to oversell to rebalance their indexes. And there was a very interesting article a few weeks back about the dangers of passive investing. I think it was Ray Dalio that mentioned about it, that it is almost the enemy of the market, because index funds have to overcompensate when companies drop out of that index because they effectively fail. And where they'll fail is what we're going to see, for example, in the corporate bond market, where risk has been completely and utterly ignored by investors chasing yield that they shouldn't chase, effectively going from triple B to completely unsolvable junk status. There'll be so many fallen angels in this market. So equities, good strong equities that have got a good dividend payment, got a low debt, hence the pivot to value stocks in the middle of August. A lot of people and a lot of institutional money has obviously seen that there's going to be a necessary hedge if there's a liquidity crisis, because at the end of the day, it's going to take the weak ones. The weak ones are going to be the ones that are over debted. So my thoughts as an investor going forward, or for investments going forward, is really do your fundamental analysis. Look for those companies that have got overly debt, a debt exposure, and will have on a cyclical change difficulties in producing the revenue to cover that debt. Because if they're having difficulty now at such low interest rates, what's it going to be like when these rates spike? Because once everybody goes to the market, that's it. It's curtains as far as the bond market's concerned, and we're going to see a repeat, if not worse, of 2008, if not worse. And so the danger is a liquidity freeze and basically small cap stocks, mid cap stocks not being able to meet their commitments as far as bondholders are concerned. And that's not even including the banks whose tier one capital is just going to go up in smoke. So yeah, if this thing goes, it's going to go with a bang. And we may have just seen with the repo rate the first stirrings of a rebellion of the market against the financial communism that we've seen over the past 10 years since the last great crisis. Now, the Great Recession has never gone away. We've got the Great Debt crisis now coming up. And yeah, it's something that you need to be aware of. So by all means, keep investing, but be very, very dicey, very, very careful about companies that have got too much debt, especially debt that they can't pay off in a downturn. Well, thank you so much again for watching this video, and I look forward to presenting the next video, and I'll see you then. Thank you and bye.